What's going on, traders? Welcome back for another video. So you're really going to enjoy this one, and hopefully I can clear some things up for you. Now, this video is really designed just to help you with your entries and identify the pinnacle continuation areas in the market, especially when the markets are trending. So the first thing I want to draw your attention to here is just how trends work. We know trends make lower lows and lower highs, especially when they're in a downtrend. This will classify as your lower high, this is your lower low, this is your lower high, and this is your lower low. Now, when we're trading, a lot of traders tend to get into trades really late, especially when the markets are trending, because they sit there most of the time watching it move down without getting in. Well, what we're going to be doing today is identifying areas in the market that are suitable to be taking trades and that will give you the highest probable opportunity of winning them. That area, especially in a downtrend, is classed as a lower high. The reason why you want to be getting in a lower high is because when a trend is trending down, more often than not, price will create a lower high that will then eventually in the future create a lower low. If you decide to start taking your trades later on as the market is in a push phase creating those lower lows in a downtrend, then there's a very high chance that once you take these trades, you will find that the markets will pull back to create a lower high before a continuation, or you will find that the market will pull back to make a double top, stopping you out before then continuing down. So this is something we're going to address today, and we're going to try to avoid. Now, if the market is trending up, what you'll find the market will do is create higher highs and higher lows. This is your higher low, this is your higher high, and this is your higher low. The area in the market where you want to really be entering your trades is at the higher lows. Again, the reason for that is because after a higher low in an uptrend, more often than not, price will create a higher high. The later you enter your trades in a push phase or a higher high, the higher the chance is that you're going to lose this trade, because after a push phase, what usually will happen is price will pull back to make a new higher low before continuing up, or potentially coming back to the previous higher low to then make a double bottom before then continuing up. So today I'm going to share with you a few tips, tricks, concepts and principles you can apply to your trading to help you get in at the best possible places or entries. So here we have an example here on gold. You can clearly see the market is trending down. We have price creating lower highs and lower lows, lower highs and lower lows. Now the question is, if we're looking to take sells, we want to be able to identify the lower high in order to take a continuation trade as part of the overall trend, which is down. So what we got to be waiting for patiently is identifying where this lower high can form. Now, the first concept or principle you need to be looking for, especially if the market is trending down, is looking to see bullish pressure failing to make new highs. Because in a downtrend, if the market is going to create a new lower low or a lower high, then eventually price has to stop at one point before continuing. So at this stage, the way we would identify this is multiple wick rejections and or an area in the market where price cannot make a new high. I said area, not a single line. So if we look at this data here, comparable to what we have here as an illustration, we can see around 16 hours worth of information confirming to us that price cannot make a new high. That's the first principle. The second thing that we need to be looking at here is momentum in the direction we wish to take the trade. And the way you're going to identify that is by a big bearish candle or a bearish candle. You want this candle to come off of the back of price failing to make a new high, and then identifying the momentum in line with the trend, which is this information here. Once you have that, what we will be anticipating is that eventually price will continue to push down to make a lower low. But in order to get into a trade here and a very good entry, we need to use our intraday timeframes to decipher the behavior and the best point in time to take a trade. So we gathered the idea that this could be the lower high because of the failure to break structure, and now the momentum, which is the second phase. Let's move down to our intraday timeframes. So we're going to use the 30-minute time frame here to understand the behavior. We know that the behavior of this market at this point in time, from an intraday perspective, is an uptrend. You can clearly see the market is making higher lows and higher highs, higher lows and higher highs. The most important concept here when looking for a lower high on the 4H time frame was price failing to make new highs. So if you look at this information on the 30-minute time frame, you can see price is failing to make new highs. The behavior is no longer clearly identifying higher lows and higher highs. We can see more of a consolidation. During the period of the pullback, this intraday trend did not at one point break this key level, which I like to refer to as a brick wall. But all of a sudden, you can see now we've had a violation of this brick wall. This is now starting to indicate to us bearish sentiment. Now what we want to start to identify is a pattern that we can trade. And the way you'd identify that is through either double tops, break and retests, lower highs, whatever patterns you trade. And once we get the information, what we can start doing is piecing the puzzle together. So for me now, I'm starting to identify a structural high, a structural low, a potential lower high, and price respecting that structure. This to me, I identify as a double top. I also identify price failing to make new highs, which is the pullback lower high on the 4H time frame, and for the first time in a long time on an intraday basis, a violation of this trend line or brick wall. Now that I have that information, I need to ask myself, do I feel that I'm taking the trade at the pinnacle area of this lower high before the market leaves without me to create that lower low? I think with the confluences that we have, we can certainly say for sure yes, and we can take our trade. Place your stop loss above structure wherever you want to be taking this trade and go for your targets. Now notice we're not aiming for the lower low because we're trading on an intraday time frame. We just need to be taking a trade with enough range before price makes that lower low. Because by the time price gets down here, there's a very high chance that firstly, we won't break the lows, and secondly, price may pull back to make a new lower high, resulting in us being stopped out. So let's take this entry and see what happens. Now, I want to mention to you as I'm taking this trade that this is an example, so I want you to focus more on the principles and concepts, not so much so that we've chosen the trade that wins. Because for the majority of you, if you're able to apply this to your trading, you will see massive, massive results. So we win this trade. Now, I want to identify where we took this trade from a 4H perspective. Remember in our examples, we don't want to be entering too late. We want to be entering at the pinnacle area in the market, which is at the lower high with the earliest signs that we can find from our intraday timeframes. This red line represents our entry. And when we go to the 4H timeframe, you will see this for yourself. We clearly identified an area, which is the first concept or principle, price failing to make a new high. We also identify the momentum. From an intraday perspective, we see the trend line break or the brick wall break and the pattern that formed, and look at our entry here. A beautiful entry taking advantage of all of this momentum and being able to win our trade. That's example number one. For example number two, I want to bring your attention to something that's really, really important here. We know that we're always looking for an area in the market where price is failing to break below to potentially indicate to us that we have found the higher low. We can clearly see that the trend of this market is trending up, and we can also see that price is making higher lows and higher highs, higher lows and higher highs. Now at this stage, we come to the charts and we can identify that this is the higher low now only because these two candles have pushed bullish. So that means we're kind of late to the party, and or there was no signals to identify that price was creating those wicks to form that higher low. So what we want to do at this stage is we want to remain patient. We know eventually that the markets will create a higher high. Now the way I see this structure here is that price is failing to make new lows at this point. This is an area in the market where we see the most wick rejections. If price breaks out of structure and breaks back in, I identify this as an indecision. So the level that I'm concerned about is just this one here. But still, I'm late to the party. The higher low is formed and the push phase has started. So what you want to be doing is you want to be marking an area where you believe price will break above to eventually make that higher high. But how do we judge that we have enough range here to take this trade? Well, what you want to do is look at past behavior and identify how much price has pushed before. So you can see this is a previous push phase after the higher low was formed. This is the next push phase after the price formed the higher low. And now we take this behavior over here where the price is failing to break below and move this here. This now means that there's a very high chance price can continue to push up to these highs. So what are we waiting for? Well, we're just simply waiting for price to break above structure. Once we have that break above structure, we know that the momentum has kicked in, the bulls have taken over because we violated a key level where price failed to break for a long period of time. Let's scale down to our entry time frame. Here on the 15-minute time frame, we can clearly see a lot has been happening, but let's break this down. This is the pullback on the 4H time frame. This is an intraday downtrend creating lower lows and lower highs. At no point in time did price break above this structure to indicate bullish sentiment. But finally we have this break above structure. It broke the brick wall and at the same time is now starting to create higher highs and higher lows. This is signifying to us that the bulls are back in control of the market, and now we just need to look for our entry. What we're waiting for is for price to patiently come back to our key levels for a retest or create a double bottom to identify us that there's a tradable opportunity. Here in this instance, we're going to be looking at this area in the market, not just a singular line. Now let's remove some of this data here and pop this line in again so you can see this clearly. So we have, just to highlight this, the 4H time frame pullback, the break of the brick wall, new higher highs and higher lows being formed, a break above structure, and a retest for potential targets to this high, which will match the range of the previous push phases. We have multiple wick rejections now, which is in line with our uptrend buying, which is price failing to break below structure. And we also have an identifying mark from an intraday perspective of bullish momentum. So now we have enough confluence to take this trade. However you take this trade is entirely up to you, but for this example, we're just going to go for a 1 to 2 with a buy stop order, and we're going to target the area where we believe price is going to come back to as part of this push phase and higher time frame uptrend. So we enter the trade, and as you can clearly see, we've done pretty well here in bringing those confluences together and applying it to our entry time frame. So I really want you to try and focus on this as you continue to trade multiple time frame analysis. This will definitely help you find some extremely good entries. As I said, sometimes you'll find the higher low and lower high, other times you won't. And if you don't, then just wait for the break and retest and the continuation, making sure that you target the ranges that you believe price is going to get back to. So I hope you found that useful, traders. The two principles you really want to be focusing on here is making sure that you identify a level that will signify potentially your lower high or your lower low as an area where price is failing to make a new high or low. That will be representative of wick rejections, indecision candles, and then the next step you're looking for is for those momentum candles to be in the direction you plan to take that trade, whether it be bullish or bearish. Once you have that information, you can scale down to your intraday timeframes or your entry timeframes to look for areas where the intraday trends have exhausted, violated the brick wall or trend line, and then look for those patterns to add confluence to those trades. I hope you try it out. Let me know in the comments what you think of it. Make sure you backtest it. And as I always say, if you've enjoyed this video, make sure you smash that like button for me, subscribe if you haven't already, turn on notifications, and until next time, continue to trust the process.